We start right there with the trade war tech pain. Check out some of the carnage today as Alphabet and the chip makers pull away from Chinese tech giant Huawei. The chips getting crushed. Qualcomm, Broadcom both down 6%. Apple's down 3% as HSBC says there's more trade war pain ahead for the tech giant. So with tech caught in the crossfire, what do you do right now? Guy.
Well, I think you think the market's going to continue to go lower. I could say you go to healthcare, you go to energy, but the short of this is the market double topped in the S&P at 2940. We've talked about that a number of times. I don't think the VIX is nearly high enough to equate with what's going on in the world. And quite frankly, if you think there's some U.S.-China trade deal that's going to be struck in the 11th hour, I don't think it's going to happen. And I've said this for a while. I think the Chinese have been stringing us along. I think they've been preparing for this for months, if not the last year. And I think there's more pain ahead for the broader stock market.
I mean, the semis alone for the past month down about 17+% here. So we're getting the swipe of just the general trade war hitting the broader sector, but also the specific hits because of Huawei.
Yeah, and obviously, as we see Google begin what's going to be an exodus of U.S. companies from doing business with Huawei, you have this sense of this is really happening. I don't think people. So, Guy talked about the Chinese maybe have been planning this for a long time. He may be absolutely right. No question the market has not been planned for this. And the reality is what's gone on here is it looked like we were going to cut a deal that seemed to me, based upon all the details we had of this deal, which was going to be a great deal for China. So actually, if you want to put your American flag on right now, I think it's not a bad place for to be pushing back on a trade war that I think was not going to be solved based upon the rhetoric we were hearing up until we heard it got nasty. The bottom line here is that markets really didn't price this in. And if you think about the genesis of the trade war last year, it really led to this place where CEOs began this dialogue of uncertainty that began to dominate the headlines. And that is leading indicators. And that is a context of where, let's face it, think about the places we would be all most concerned on this desk if the world really slowed down. We'd go to Europe. Well, guess who's got the biggest export economy? It's effectively Europe. And they're going to suffer a lot more than we will. So a pullback of 4% in semis is dramatic. And in fact, it's cascading. It's not getting better here. And I just think that markets, which on the headlines and maybe even to the administration appear not so bad. S&P's down a little bit. Obviously, if you look at emerging markets, we're at all-time lows on a relative basis to the S&P, meaning they've been absolutely underperforming and at their worst level ever.
Yeah, so it's interesting. We've mentioned the semis a couple times here, and we know that 2018 was a really weird year for this component supplier to all of these major OEMs, which Huawei is a major Android OEM. They make almost 25% of the handsets on Android, and it's really important to remember because we talk about Apple versus Android. Android has like 85% market share globally. So when you think that Huawei has 25%, this is a really interesting time for the supply chain on the smartphone market at a time when we know that we are seeing a plateauing of demand. We've seen actual smartphone units drop year over year for the last 3 years here. So what's really interesting to me is that the SMH, the ETF that's tracked the semiconductor group, is down about 18% from those recent highs. Last year, when this was an omnipresent threat to the supply chain and smartphones, we had almost a 30% peak to trough decline. So, yes, it's gone down in a straight line, 17%. Is there more to come? Possibly. This is going to be a drawn-out thing. And let me just tell you, this is not really a big positive for Apple for a whole host of reasons. We know Apple is down 3.5%. This is actually huge for South Korea's Samsung. I mean, very obviously.
Yeah, so, typically during periods of political uncertainty, that ends up being a contrarian indicator. So the way I feel right now is there's just a lot of market noise right now. And if you're able to tune out the market noise and you still believe that the uptrend is intact, it gives investors an opportunity to identify some positions that they'd like to be in, possibly at some very attractive entry points. So when we talk about tech, yeah, semis are getting crushed, but there's still a big opportunity within software. So a lot of the software companies, you're talking high margin revenues, recurring revenues on a subscription basis. So companies like Salesforce, Microsoft, I think there's some great opportunities to get in at great prices within those stocks.
So tune out the noise when it comes to sectors that are not being directly hit.
Correct. It gives you an opportunity to find good value, right?
Is there a way to tune out the noise within semis, or the sectors that are directly?
But here's the thing: it's really dangerous. Listen, all those high recurring revenues, the software names, they actually haven't gotten hit yet. The S&P 500 is not even 4% from those highs. You're looking at a high growth area like once high growth area like semis down 17%. I think to dip your toe in the water right here, down 4%, with Microsoft down just a few percent from the highs, you might be a little early, and it really depends on your time horizon. Salesforce is another one, high valuation. high growth. But, if we do have a protracted trade war, what really that means is we might see enterprise spending drop.
Yeah.
Which is going to be software and which
Right.
is going to be cloud. And some of this was already getting to a place where we were starting to hear some pushback in terms of demanding cloud. And depending on who you were talking to, despite the fact that it's been the driver of Microsoft's outperformance, it's been a resurgence for Intel. I think these are places. So I would agree with Dan, at least that I think the enterprise spend is at risk here. I think we haven't gotten a fresh downgrade of global growth because we just don't know yet. And I think what's going to be really interesting here is you could make an argument that the Fed, essentially the impact of the Fed hikes has not been fully felt by markets yet. And you add in a stronger dollar, and you really have another tightening condition.
I mean, that's the argument of UBS's strategist, who has a 25.50 price target on the S&P 500.
That the Fed has not been
fed?
The
hikes that had happened last year have not been felt yet. And so we're still waiting for that to hit as we potentially are getting into the slowdown. But in terms of enterprise spend, are you worried about that? Should this?
I am worried about enterprise spend, but I do feel like Salesforce is one of those companies that's insulated from it. I mean, what Salesforce does is they provide a CRM program to businesses that improve profitability, improve efficiency, and I think when the economy actually slows down, there are going to be a ton of costs that get cut way before anyone cuts their CRM program. I mean, you'll drop employees, you will drop advertising costs, marketing costs, but you're not going to drop the engine that drives your business.
And listen, we've loved Salesforce on this for quite some time. We've talked about it, but in this environment, in a stock that's trading close to 50 times forward earnings, to Dan's point, at a certain point, people will look and say, you know what, valuation is too rich. Let's start getting out of some of these high flyers. I don't think they'll be protected from that, in my opinion.
Yeah, but Mark, your analysis is not wrong by any means. It's really a matter of timing, and I think it's really important to remember that, when we had these exact same concerns in Q4, when these high growth names were getting nailed, they had 30-40% peak to trough decline. So my view is that Salesforce, was trading at 165, now it's 155 on a 3.5% move from the highs in the S&P 500. You may want to be a little patient, is all I'm saying. It does matter. Time horizon matters.
What do you do with tech more broadly?
Well,
I mean, how do you feel about tech, given the environment and given that higher multiple names could get hit the hardest?
I think we've seen this at different. If we're going into maybe a second half of the year where you're going to start to get downgrades on global growth beyond what we've already endured. I think we've seen that the market, the high multiple names, don't perform. And in fact, they're under attack. And you can make an argument that actually the damage technically, and I'll leave this for all those great chartists we have on, but something like a Netflix is resting really right on top of a level that it rose up to after the downdraft of December, and in fact is getting very much near this 230 level on Netflix. Means you fall off here, and there's some big multiple names that I think run into some trouble. So I think if you're playing defensively here, it's probably in the bricks and mortar of tech. And it may be in even an NVIDIA, at least where you've gotten recent data points. And you have companies that maybe have carved out a moat in terms of their core business and their chips.
Right. You're eyeing NVIDIA, right, Mark?
Yeah, I love NVIDIA. I mean, I'll tell you what, if this stock pulls back a little more, if we can get it in that 130 to 145 price range, if it falls into our lap, we'd be buying shares right now. I mean, in my opinion, it's a best of breed chip stock. It gives us exposure to autonomous vehicles, gaming, data center, all the places we want to be, and I think it's almost priced right.
I think it's fair to pick levels, and I think that's what you should be doing if you're watching at home. But one thing I'll say in terms of the broader market, the S&P made an all-time high within the last couple of weeks. The Russell never verified that, by the way. As a matter of fact, the IWM didn't get anywhere close to where we saw over this past summer, which to me is troubling. So again, you look at the S&P 500, in my world, that's a major double top at 29.40, 45. Pick your poison, and it doesn't sort of bode well, especially with the VIX at 16.5, which to me speaks to the complacency that's been in this market for the last decade.